What are the key options rules to pass the Series 7 exam? Imagine preparing for a test that covers a wide array of financial instruments, strategies, and regulations. The Series 7 exam, officially known as the General Securities Representative Examination, is designed to assess a candidate's knowledge of investment products, trading procedures, and regulatory requirements. To succeed, understanding the fundamental rules surrounding options trading is essential. Options are financial derivatives that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price within a certain time frame. The key rules focus on the classification of options, the types of options available, and the specific regulations governing their trading. First, it is important to recognize the two main types of options: call options and put options. A call option grants the right to purchase the underlying asset at the strike price before expiration. Conversely, a put option gives the right to sell the underlying asset at the strike price within the designated period. Knowing these distinctions is fundamental for understanding options strategies and their associated risks. Second, options are classified as either American or European style. American options can be exercised at any point before the expiration date, while European options can only be exercised on the expiration date itself. This distinction influences trading strategies and risk management considerations. Third, the rules specify the minimum and maximum contract sizes for options. Typically, one options contract represents 100 shares of the underlying security. This standardization simplifies trading and ensures consistency across transactions. Fourth, the expiration date is a critical element. Options generally expire on the third Friday of the expiration month. Traders must be aware of this date because exercising or closing positions before expiration can significantly impact profitability and risk exposure. Fifth, the strike price or exercise price is the predetermined price at which the underlying asset can be bought or sold. The relationship between the strike price and the current market price of the underlying asset influences whether an option is considered into money, at the money, or out of the money. These classifications affect the option's premium and potential profitability. Sixth, the rules regarding margin requirements are vital. When trading options, especially when writing or selling options, investors must maintain sufficient margin accounts. The Financial Industry Regulatory Authority requires specific margin levels to ensure that investors can cover potential losses, which vary depending on the type of options position. Seventh, understanding the concept of assignment is crucial. When an options writer is assigned, they are obligated to fulfill the terms of the contract. The rules specify how and when assignments can occur, emphasizing the importance of monitoring open positions and maintaining adequate collateral. Finally, it is essential to grasp the regulations surrounding prohibited transactions and manipulative practices. The Securities and Exchange Commission and the Financial Industry Regulatory Authority enforce strict rules to prevent fraud and ensure fair trading. This includes restrictions on trading ahead of customer orders, spreading false information, or engaging in manipulative schemes involving options. Mastering these options rules provides a solid foundation for passing the Series 7 exam. Focus on understanding the classifications, contractual obligations, expiration and strike price details, margin requirements, and regulatory constraints. With diligent study and practical application of these principles, candidates can confidently navigate the options section of the exam and demonstrate their competence in options trading regulations.